also a dynamic about debt. When debt and debt service rise relative to your income, it's like plaque in the arteries that then begins to squeeze out the spending. And also because one man's debts are another man's assets. If those don't give a good real return, they will sell. So
Every major financial collapse in the last 50 years has followed the same pattern. Exactly the same. Same dominoes in the same order. And right now, we're watching those dominoes fall again. But here's what most people don't understand. We're only at domino number 4. There are 10 total, which means we're halfway through a sequence that ends in one of two ways: hyperinflation or complete currency collapse. And I'm not guessing. I can show you exactly which domino falls next, when it hits, and what happens to your money when it does. Let me take you back to 1923, not because it's ancient history, but because it's a case study in how fast everything can break. Because what happened in Germany in 9 months is the exact blueprint of what's happening right now in 2025 in America. And understanding this sequence is the only edge you have. December 1922, the normal period. Life in Germany looks normal. Prices are going up. People notice. Inflation happens, right? You get your paycheck, you buy groceries, your kids go to school. There's unemployment. But every country has unemployment. Nothing feels fundamentally broken. It feels like a bump. Economic bumps are normal. A loaf of bread costs around 160 marks. That's expensive compared to a few years ago, but people complain and move on. They have jobs, they have routines, they have savings. They think the government will fix this. They trust the central bank. They read headlines saying temporary measures. Everything feels like it'll bounce back soon. January 1923, the trigger. Something changes. France and Belgium invade the Ruhr Valley. That's Germany's industrial heartland. 85% of German coal production. 80% of their steel. The most productive factories in Europe. Gone. Under military occupation. Suddenly the government can't produce anything exportable. They can't create revenue. But they still need to pay workers. They still need to keep government running. Soldiers need paychecks. Teachers need paychecks. The entire system still requires fuel. So what happens? They print money. The central bank starts printing. Not crazy amounts, measured amounts, emergency measures, they call it. Temporary solution. Everyone expects it to get fixed soon. Surely France will negotiate. Surely this is temporary. And here's what nobody talks about. Nobody panics yet. Because people are used to printing money during wars. They think you print money, the economy recovers, life continues. It feels normal. History has taught them this works. March 1923, the acceleration. But something weird starts happening. Inflation isn't slowing down. It's speeding up. The more money they print, the faster prices rise. It's not fighting inflation. It's feeding it. Businesses stop accepting paper money. They want gold. They want real goods. They want anything but marks. The government responds by making it illegal to demand gold. You must accept marks. But what good is a law when nobody wants your currency? Prices start changing weekly, then daily, then multiple times a day. Shop owners don't even bother writing prices in windows because they know they'll be wrong in an hour. Mid-1923, the collapse begins. Now people understand something is genuinely wrong. A single egg costs 9 marks. Then 26 marks, then 100 marks. A weekly grocery basket that costs 370 marks in April costs 2,615 marks by September. That's a 600% increase in 5 months. Workers start getting paid twice a day. Not because they get raises, because their wages become worthless by lunchtime. Literally. You get paid at 9 in the morning. Your wife is waiting at the factory gate. She grabs the money and literally runs to the shops before the new exchange rate comes out at noon. Because waiting 1 hour means losing half your purchasing power. A woman walks into a bakery with a basket of marks. While she's standing in line, the price changes. She can't afford bread anymore. The marks in her basket are worth less than 1 loaf. She leaves empty-handed. People start bartering. Landlords demand payment in food. Doctors demand payment in coal. Hairdressers demand payment in butter. The currency is still legal tender, but nobody uses it. It's worthless. Social breakdown starts. Elderly people who say their entire lives have nothing. Their life savings are worth fractions of a cent. Mothers can't feed their children. Families are living on the streets. October 1923, the nightmare. $1 is worth 4.7 billion marks. Let that sink in. $1, 4 billion marks. The hyperinflation is so extreme that the government can't even print money fast enough. The printing presses can't keep pace with how fast money becomes worthless. The government is printing at maximum capacity, but it's not enough. Prices don't just change daily anymore, they change every few hours. Restaurants refuse to serve customers because food prices change between when you order and when you pay. The restaurant would lose money on the transaction. People are literally burning money to stay warm. It's cheaper than buying firewood. That's not an exaggeration. That's what's actually happening. Money has negative value. Workers refuse to take wages. Why? Because by the time they get home, it's worthless. They literally lose money by working. The entire economy has stopped functioning. November 15, 1923. The breaking point. Checkmate. The government finally admits the old currency is dead. The new chancellor, Gustav Stresemann, does something radical. He stops the printing presses, literally orders them shut down. The Reichsbank stops printing immediately. He introduces the Rentenmark, a new currency backed by land value, not gold. Land, but at least it's backed by something. At least there's a hard stop to printing. And here's what matters. The old marks become worthless overnight. People can still legally hold them, but they're worthless. Everyone with life savings wiped out. Mortgages that were crushing people. Technically paid off with worthless paper, but they lost their ability to pay anyway. Pensions, gone. Bonds, gone. Life insurance, gone. The entire middle class's wealth evaporated in 9 months. Here's what people don't talk about. After the currency stabilizes, society doesn't bounce back. The political system is destroyed. People have lost faith in everything. They lost faith in government. They lost faith in institutions. They lost faith in democracy. And you know who fills that void? Extremists, populists. People offering simple answers to complicated problems. People saying this happened because of that group. People who promise to fix everything with anger instead of solutions. That economic crisis created a power vacuum. And that vacuum filled with fascism, with Hitler. The hyperinflation didn't just destroy the economy. It destroyed the society. It destroyed the culture. It destroyed the political system. A 9-month collapse led to a 16-year nightmare that killed millions. And here's the scary part. America in 2025 is not in December 1922. We're not in normal territory anymore. We're not even in January 1923 yet. We're already past that. We're in mid-1923, and most people don't realize it. Here's where it gets weird. Here's what makes you sit down and really pay attention to the data. The stock market is at all-time highs. The S&P 500 is breaking records every week. People are celebrating. They're posting portfolio gains on social media. Your uncle is bragging about his 401k. Your mom's financial advisor is saying stay invested. Everything looks great if you only look at stock prices. But meanwhile, here's what's actually happening. The federal government just spent $7 trillion in 2025. They'd only collected $5.23 trillion in revenue. That's a $1.8 trillion deficit every single year. And that number isn't going down. That's not getting fixed by cutting some programs. That's structural. The government is literally spending almost 34% more than it collects every year. They're not slowing down. They're not cutting spending. They're not raising taxes enough. They're doing exactly what Germany did. They're printing money to cover the gap. So here's the contradiction nobody wants to say out loud. How can stocks hit all-time highs while the government is essentially bankrupt? The answer is simple. It's not really all-time highs. It's inflation. You're not getting richer in real terms. Your money is getting weaker. Stocks have to go higher just to stay flat in actual purchasing power. But people see the number on the screen go up and think they're winning. It's like being in an elevator that's slowly falling. The floor numbers keep rising. You go from the 15th floor to the 20th floor to the 25th floor. But the elevator is moving downward the whole time. You're descending in real terms, but the number on the wall says you're going up. Here's the second contradiction. Zombie companies are at multi-year highs. Over 100 new zombie companies appeared in October 2025 alone. These are major, well-known corporations that can't even earn enough money to pay their interest. They're basically on life support. Lionsgate, Altice USA, Frontier Communications, these aren't small companies. These are substantial corporations, and they're everywhere now. A third of all corporations fit this definition. These shouldn't exist. In a healthy economy, they would die. The market would kill them. They'd go bankrupt. That's how capitalism works. You can't make it, you fail, your assets get restructured, your debt gets written off, you disappear. But these companies don't disappear. Why? Because if they fail, it triggers a chain reaction. Because the economy is too interconnected. If Lionsgate fails, Comcast has exposure. If Comcast fails, banks have exposure. If banks fail, the whole system fails. So the Fed keeps rates high enough to avoid collapse, but not so high that companies start failing. It's a tightrope, and they're right in the middle of it. It's checkmate. Raise rates too much, the zombies die and the whole system collapses instantly. Lower rates too much, you destroy the currency, and we're back to Weimar burning money to stay warm. There's no good move left. The Federal Reserve is trapped. Picture a tower, a really tall tower made of Jenga blocks. You know the game. You pull out a block, the tower gets wobbly. Pull out too many, the whole thing falls. Except in this scenario, you can't pull blocks out. Blocks can only be added, and they're getting heavier, much heavier. Block 1. U.S. government debt, $38 trillion. The largest debt any country has ever accumulated, and every single year it grows by almost $2 trillion more. This block is massive. It's the foundation holding everything else up, but it's cracking. Block 2. Corporate debt, $11.8 trillion. But here's the catch. A third of these companies are zombies. They only survive because they can refinance cheap debt. They only exist because the system won't let them fail. Touch this block, it wobbles. A lot. Block 3. Consumer debt, student loans, credit cards, auto loans. Regular people are stretched thin. The average American household has $145,000 in debt. That's house, cars, credit cards, student loans combined. That's a lot of weight on one block. Block 4. The dollar's reserve currency status. Why does America get away with printing all this money? Why does the currency collapse? Because the whole world uses dollars. Every country holds dollar reserves. Every major transaction happens in dollars. The dollar is the language of global finance. If that changes, if countries stop using dollars, if they switch to euros or Chinese yuan or something else, then this block becomes unstable, and when this block moves, everything above it moves. Block 5, your retirement, your house value, your paycheck, your kid's future. Everything you own is balanced on top. Everything depends on the blocks below staying stable. Now, here's the thing about this tower. Nobody's actively holding it steady. It's not being maintained. It's just balanced, precariously balanced, and the blocks are getting heavier every single day. Every day the government prints more money, the blocks get heavier. Every zombie company that can't pay its debts to stabilize the block. Every time the dollar gets weaker internationally, that's someone pushing slightly on the tower. Not hard, but a little push. A light push won't break it. But eventually something has to give. One block shifts just slightly, and then it's no longer supporting the blocks above correctly. And then those blocks shift, and then they all topple. Not one at a time slowly, all at once. That's how these work in reality too. The economy isn't made of independent parts. It's systemically interconnected. One bank falls, it affects credit markets. Credit markets tighten, companies can't get loans. Companies can't get loans, they cut production. Production cuts, people lose jobs. People lose jobs, they can't pay mortgages. Mortgages default, banks lose money. Banks lose money, credit tightens more. It's a cycle, and once it starts, nobody can stop it. Here's the sequence. The inevitable chain of events. This isn't a guess. This is cause and effect. Interest rates don't come down as much as people expect. Maybe they even go up, because inflation doesn't cooperate, or because the Fed has to defend the dollar's value. And companies suddenly can't refinance their debt as easily. The zombie companies especially. They were barely surviving at low rates. At higher rates, they start defaulting. Not a few, multiple. Lionsgate can't refinance $500 million in debt. Nobody buys the bonds, not at any price. So they default. Banks that hold this debt take losses, real losses. These aren't small companies. These are real corporations with bonds held by major institutions. When they default, Morgan takes a hit. Wells Fargo takes a hit. Regional banks take a hit. These banks have this debt on their balance sheets as assets. When the company defaults, that asset is suddenly worth 50 cents on the dollar, or 30 cents, or zero. Banks tighten credit. This happens automatically when banks take losses. They become risk-averse. They stop lending to risky companies, then to medium-risk companies, then to less risky companies. Suddenly, there's a credit freeze. Even companies with good balance sheets can't get loans, even profitable companies, because the bank doesn't have the capital, because they're scared the next company will default too. Companies can't operate without credit. This isn't theoretical. It's practical. You can't make payroll without a line of credit. You can't buy raw materials without credit. You can't grow. Companies cut jobs, not by choice, because they have to. Revenue is down, credit is gone, costs are cutting automatically, layoffs start. Amazon cuts 10,000 workers. McDonald's franchisees cut staff. Retail stores close. Consumers lose jobs or get scared about losing jobs. Unemployment starts rising. People start paying off debt instead of spending. They cancel Netflix. They don't go to restaurants. Consumer spending drops. And remember this, 70% of the American economy is consumer spending. If consumers stop spending, the economy stops growing. It starts shrinking. Companies see revenue dropping, not some companies, all companies. Their customers aren't buying. Suddenly, Amazon's cloud division has fewer customers. Starbucks has fewer customers. Airline ticket sales drop. Companies make less revenue. They cut more jobs. They try to drop prices. Competitors drop prices. It's a race to the bottom. Profit margins get destroyed. Stock prices fall, then crash. The stock market realizes the earnings forecasts are wrong. Companies are making less money. Profits are declining. So stock prices should fall. And they do. Fast, cascade selling. The market crashes 50%. Then we get to the end game. Banks can't pay everyone who wants their money. That's the end state. When everyone gets scared and tries to pull their money out at the same time. That's a bank run. The bank has $100 billion in deposits, but only $5 billion in actual cash. The rest is loaned out. It's in securities. It's locked in long-term investments. When everyone withdraws at the same time, the bank can't pay. The government has to choose. Do they let banks fail, or do they bail out banks? If they let banks fail, the financial system collapses. People can't access their accounts. Businesses can't get paid. The economy grinds to a halt. If they bail out banks, they have to print massive amounts of money. Trillions. And that destroys the currency. That's hyperinflation. And here's the thing. Nobody can stop this sequence once it starts. It's not a choice point. It's cause and effect. Every domino is triggered by the previous one. The Fed can't cut rates without destroying the dollar. The government can't spend less without making unemployment worse. They're locked in, trapped. This is what happened in Weimar Germany. This is what's happening in Venezuela right now. This is what happened in Argentina. This is the sequence. Okay, stop thinking about the economy in abstract terms. Stop thinking about the market. Let me make this real. Let me make this about you. Your job. If you work in finance, real estate, banking, or anything tied to corporate debt, you're in the danger zone. When companies stop getting credit, they don't hire. They cut. Your division gets downsized. But even if you work somewhere that feels stable, manufacturing, healthcare, anything, companies cut during crises. They do it first, ask forgiveness later. A 15% workforce reduction isn't unusual during financial crises. If your company has 100 employees, 15 people lose their job. Is it you? Is it your team? Is it your boss? The stress alone is debilitating. The threat alone changes how you work. You stop advocating for projects. You stop speaking up in meetings. You become invisible. And invisible people get cut first. Your paycheck. When unemployment rises, wages go down. Or they flatline. You're making the same money, but it buys less. That's what matters. Your rent goes up. Your groceries cost more. Your utilities jump. Electricity costs 20% more. Gas costs 30% more. But your paycheck? Same as last year. Same number? Different value. You're losing purchasing power. You're getting poorer even though your paycheck is the same. Your house. This is the big one. Real estate is the foundation of American wealth. 62% of Americans own their homes. That's their primary asset. That's their nest egg. When credit freezes, house prices fall. Hard. We saw it in 2008. You could owe more on your mortgage than your house is worth. That's called being underwater. If you need to move for a job or any reason, you're trapped. You have to sell at a loss. Your equity? Gone. The down payment that you saved for years, wiped out. Your investment? Lost. Your house goes from 500,000 to 300,000. Your mortgage is still 400,000. You're underwater by 100,000. You can't sell, you can't move, you're stuck. Your retirement. If you have a 401k stock portfolio, you're holding depreciating assets during a crash. A 40% crash isn't off the table. It's happened before. Some people recover from it, some don't. If you're 5 years from retirement, that's not recovery time. That's your life changing. The $500,000 retirement portfolio becomes $300,000. You plan to retire on $500,000. Can you retire on $300,000? Maybe, but not comfortably. And if the crash happens when you're 62 instead of 60, you get 2 fewer years to recover. 2 fewer years of working to rebuild. Your retirement just got pushed back 5 years, or your retirement lifestyle just got cut by 40%. Your kids. This is the brutal part. If the system breaks badly, inflation spikes, costs explode. You're paying 2 or 3 times what you pay now for basics. Rent, food, energy, everything. Meanwhile, your kids are trying to buy homes, but homes are 3 times more expensive, and they can't get loans because credit is frozen. The entire financial ladder that helps you climb up, it collapses below them. They can't build the same life you built. They can't afford the same things. They're stuck. Your wealth gets destroyed. Your kid's future gets destroyed. Intergenerational wealth transfer goes backward. Your kids inherit debt and uncertainty, not prosperity. This isn't theoretical. This is what people are going through right now. In Venezuela, in Argentina, in Lebanon, in countries where this already happened. These aren't distant places. These are modern countries with modern people where regular people woke up one day and their money didn't work anymore. They tried to withdraw from their bank and couldn't. They tried to send money to their kids and the government blocked it. They tried to buy basic groceries and couldn't afford it. This is what happens, and it can happen here. But it doesn't stop at your personal finances. Level 1, personal. Your money goes first. Your savings get hit. Your job gets shaky. Your paycheck buys less. You start cutting back. You cancel streaming services. You eat out less. You drive less. Level 2, community breakdown. Unemployment spreads. It's not just you. It's everyone. Local businesses close. The coffee shop you go to every morning? Gone. That bookstore? Closed. The pizza place? Shut down. Local tax revenue drops because nobody's making money. Nobody's spending. City government gets less tax income. They cut services. Police response times get worse. Roads don't get fixed. Schools get less funding. Your community deteriorates visibly. The parks are less maintained. The streets are less clean. Crime increases because desperation increases. Level 3, social tension rises. When people are desperate, they get angry. They look for someone to blame. They look for easy answers. And there are always politicians and media figures willing to give them easy answers. The problem is immigrants. The problem is that political party. The problem is rich people. The problem is the central bank. That's when you get extremism. That's when institutions get questioned. That's when democracy gets shaky. We saw this exact sequence in Germany in the 1920s. Economic crisis, social breakdown, extremism, authoritarianism. People stopped trusting government. They stopped trusting media. They stopped trusting institutions. They look for strong leaders. People who promise simple solutions, even if those solutions are authoritarianism. Level 4, international consequences. When America's currency gets weak, the global dollar system gets weak. 70% of global trade happens in dollars. Almost every country holds dollar reserves. Other countries that hold dollar reserves get nervous. They start dumping dollars. They want gold instead, or euros, or Chinese yuan, anything but dollars. Suddenly, there's a bidding war to get out of dollars. Everyone's selling at the same time. The dollar crashes faster, harder. Global trade breaks down. Supply chains collapse. Countries can't get the stuff they need. Where's your semiconductor? Made in Taiwan. Where's your oil? Middle East. Where's your food? Various countries. If currencies are unstable and credit is frozen, international trade becomes impossible. Who ships goods if they're not sure they'll get paid in stable currency? Countries protect their own. Trade wars start. Tariffs spike. Countries refuse to trade with each other. Resources become scarce. Then real wars start. Wars over resources. Wars over currency dominance. Wars over survival. Level 5, survival mode. When society breaks down far enough, The basics become hard. Food, water, energy, security. You're not thinking about your career anymore. You're thinking about your family's safety. You're not worried about your retirement portfolio. You're worried about whether you can feed your kids next week. This is worst-case scenario, but it's not impossible. It happened in Germany in 1923. They went from normal society to complete breakdown in 9 months. Okay, the question everyone once answered, when does this happen? Here's what the data suggests. Historical debt cycles. Look at historical debt cycles. They have predictable patterns. They reset roughly every 80 to 100 years. Last major correction, 1929 to 1939. That's roughly 80 to 100 years. You do the math. 1929 plus 97 years equals 2026. That's 13 months away. Not guaranteed, but pattern. Demographic cycles. Harry Dent is a demographer. He predicted 2008 accurately, not by accident, by using demographic cycles. His model works because spending patterns follow demographic patterns. People spend most money between ages 45 and 55. After 65, they don't spend as much. Harry Dent's model flags 2026 to 2027 as a critical inflection point. Not a crash necessarily, but a major inflection, a turning point. Technical signals. The yield curve is inverted. That's historically predicted recessions with 80% accuracy. When short-term rates are higher than long-term rates, recession usually follows. Historically within 6 to 12 months. When could it accelerate? Several triggers could compress the timeline. Geopolitical event. A conflict, a terror attack, a political assassination. Something unexpected that shocks markets. That could trigger immediately. Corporate default. A major company defaults. That starts the domino cascade. That's months away, not years. Central bank policy shock. The Fed makes a surprise move, or the ECB, or any major central bank. That could reset markets instantly. Currency crisis. A major currency collapses. That creates panic globally. That's not months away. That could be weeks. Most likely timeline. Q4 2025 to Q3 2026. That's where the pressure is building. That's when major debt maturities stack up. That's when companies need to refinance. That's when the weak structure becomes visible. Could be sooner. I'd give it 15 to 25% chance of something major happening by end of 2025. Could be pushed back a year. But the window is measured in months, not years. This isn't decades away. This is immediate. Here's what happens right before the crash. The specific signals to watch. Warning sign 1. Corporate defaults. Pay attention to corporate bankruptcies. When major companies start defaulting, that's the first domino. Watch for Lionsgate. Watch for Altice USA. If they default, the cascade starts. Warning sign 2. Credit spreads. Bond spreads widen. That's when the interest rates companies have to pay jump suddenly. When a company has to pay 10% instead of 3% to borrow, that's a signal. That means the market doesn't trust them anymore. Warning sign 3. Bank stress. Watch bank stocks. When bank stocks start falling, that means the market knows they're in trouble. Watch for bank CEO statements. Watch for earnings downgrades. Warning sign 4. Dollar weakness accelerates. When the dollar loses 2 to 3% in a month, that's a warning. Not just 11% per year, but accelerated weakness. That signals a currency crisis beginning. Warning sign 5. Credit card delinquencies rise. People stop paying credit cards. That's the first sign consumers are in trouble. Not unemployment statistics, credit card delinquencies. When those spike, the consumer is breaking. When you see these signs all happening simultaneously, that's the moment. That's when the dominoes are about to fall. Here's the thing about comparing 1923 Germany to 2025 America. It's not just about the crash. Everyone wants to know when will it crash and how bad will it be. That's the wrong question. The real question is what comes after. Because the crash happens fast. It's violent. It's scary, but it's over relatively quickly. We're talking months, maybe a year. But what comes after? That lasts for years. That changes everything about your life. That changes society. That's what determines whether you survive it. In Germany, they survived the crash. The Rentenmark was introduced. The currency stabilized. The hyperinflation ended November 1923. By 1924, things were getting better. Life was normalizing. But the social destruction didn't end in 1923. The political instability didn't end. The distrust of institutions didn't end. that rippled for a decade, that eventually led to extremism, that eventually led to fascism. The crash is one event, but the aftermath is a different story. The aftermath is what really matters. And here's what I'm most concerned about. Nobody's talking about what comes after. Nobody's preparing for it. Nobody's thinking about it. If the markets crash, the government will try to fix it. They'll print money. They'll bail out banks. They'll do something. But that creates hyperinflation. If hyperinflation hits, what happens next? Do we get rent marks? Do we get new currency? Do we get a barter economy? Do we get currency collapse? And what happens to society after that? What happens to trust? What happens to democracy? What happens to the social contract? That's the real story. That's what we need to understand. Because information is the only advantage you get. And when this moves fast, you need to be ahead of it.